Hi, and welcome to an introduction to the stock market, how the stock market works. In this video, I'm going to give you the basic theoretical background and really the basics of what the stock market is all about. I'll explain what a stock is, how the stock market works, why do stock prices change. I'm going to describe something called the efficient market hypothesis, which is really the central theory of how stocks get priced. I'll talk about information bias and what you need to know and why that's important. And then I'll explain the different types of analysis that investors do in the stock market. All right, well, let's get started with just the most simple of questions. What is a stock? Well, really, it's a piece of ownership in a company. It doesn't have to be necessarily a public company. You could have a piece of ownership in a small business in your city or town. But when you own a piece of that company, you really have a claim on that company's ability to make money. You know, if a company has 1,000,000 shares and you own one share, then you own 1/1,000,000th of that company's ability to make money. And if the company makes $1,000,000 and it has 1,000,000 shares outstanding and you own one share, you're entitled to $1 if it was decided that the earnings would be paid out to investors. So the real purpose for owning a stock is to own that company's ability to make money. Now, what the stock market provides is the added benefit of liquidity. You know, if you own your own business and you want to sell it, that's not something that happens in the blink of an eye. But when you own the shares in a publicly listed stock, you can sell it and buy it very easily. You know, if you want to buy some shares of Microsoft or sell some shares of IBM, you just log into your broker's trading system, and that can be done very, very quickly and very easily. And so public companies that are listed on public stock exchanges actually have a higher value relative to their earnings because of the liquidity. All right, you're willing to pay more for the convenience of being able to buy and sell it very easily. Now, what is the stock market? Well, it's really a facility for the buying and selling of public companies and their stocks. When you go to the New York Stock Exchange or the NASDAQ Stock Exchange, there are companies that are listed on those exchanges to make their shares available to the public to buy and sell. And it's also, the stock market is really a forum where people debate about what a company is worth. You know, as I said earlier, a company's value is based on its ability to make money in the future. Well, that's a decision that's a little bit difficult sometimes to figure out. We don't know what is going to happen in the future. We don't know how much a company is going to make in the future. So the job of investors is to really argue about what that value is, to take all of the information that they have about a company and its ability to make money and say, well, based on what I know, I think the stock is worth $10 a share. Well, someone might have a very different opinion than you. They may have done that analysis and said, well, based on what I know about the company, I think it's worth $12 a share. And the argument that goes on every day in the stock market is this buying and selling back and forth to arrive at an equilibrium price. What you have to remember is that for every buyer in the market, there is a seller. The buyer thinks the stock is worth more, and the seller thinks that the stock is worth less. And they're really debating in the stock market about who is right. Now, as I said earlier, there is added value to being a public company because the listing on a public stock exchange provides liquidity. It makes it easy to buy and sell the stock. There's also a certain amount of legitimacy that comes by passing all the regulations that it takes to be listed on a public exchange. And so typically a public company will be worth more than a private company. Now, why do stock prices change? Well, as I said, it's what you're willing to pay for a stock is really based on your perception of the future earnings potential of the company. And that's what price is. It's a snapshot at that moment of what investors think the company's ability to make money in the future is worth. Now, second by second, minute by minute, day by day, month by month, there is a steady stream of information coming to investors about what companies are worth, about the state of the economy, about the political realm, about the conflict throughout the world, all of those things that can affect the ability of a company to make money in the future, all of that is streaming down to the investor, and it is a factor in what people will pay for a stock. There is a tremendous amount of uncertainty in answering that question, what will a company make in the future? And because there is uncertainty, there is then also volatility in price movement. If you watch the market, you will see that stock prices move all over the place. Second by second throughout the day, prices will change. And the reason prices are changing is because you have differing investors with different opinions about what the company will make in the future. Now, it's real important to focus in on the future, because what happened in the past is really irrelevant in the stock market. The stock market doesn't care what happened yesterday. The stock market is a discounting mechanism for what will happen in the future. And a lot of investors make the mistake of saying, well, in the past, this stock was worth $20 because of all the great things that they did, so it should get back to $20. Maybe it's trading at $15 today. But I got to stress, what happened in the past doesn't matter. All that the market cares about is what will happen in the future. And of course, the future is uncertain. So when we talk about future earnings, the concept is this idea of the present value of future earnings expectations. The market's job each and every day is to figure out what will the company make tomorrow, what will they make in a year, what will they make in 5 years, and to figure out what that is worth today. Now, a dollar in your hand today is worth more than a dollar in your hand 5 years from now. Why? Well, if you took a dollar that you had in your hand today and put it into some sort of investment vehicle, it's going to earn some return, right? And in 5 years, that dollar might be worth $1.10, $1.20, depending on the kind of return that you can get. So when we talk about this concept of the present value of future earnings expectations, what it really means is that money in the future is worth less than money today. The money a year from now is worth more than money 5 years from now. And so when people analyze stocks, what they're trying to do is say, well, I think next year the company's going to make this, and 2 years from now they're going to make this, and they're going to continue to grow at 10% a year, or whatever the particular analyst believes that the growth of the company will be, and that is how they arrive at what they think the company is worth today. Now, if through that calculation they say, okay, based on my analysis, I think this business is worth $300 million, and there's 1 million shares outstanding, well, then you would expect that the stock should trade for something around $300 a share, because $300 a share times 1 million shares equals $300 million net worth of that company. Now, there's a lot of uncertainty in that calculation. We don't know what the company is going to make next year, but we certainly have even less certainty about what the company will make in 5 years. And so the job of the stock market is to really argue about that and figure out what it is all worth. Now, the efficient market hypothesis. This is the thing that you learn in finance classes in university. It's kind of the backbone of pricing theory in the stock market. And it really argues that the stock market cannot be beat. Now, what do I mean by that? Well, historically, the stock market earns 7 or 8% per year on average. Some years it'll earn 20%. Some years it'll lose 3%. I mean, every year is going to be different, but on average, the market earns about 8% per year. Now, people that believe in the efficient market hypothesis will say that because all available information is priced into the stock almost immediately, you cannot expect to beat the market because what the future information will be is just random. You don't know what the information tomorrow is going to be, so how can you predict where stock price is going to go? And if you believe in that, then really what you should do is simply buy an index fund and earn what the market earns. There are two assumptions of the efficient market hypothesis. The first is that, in fact, all available information is priced into the stock and that everyone gets that information at the same time. And the second assumption is that investors will act rationally. Now, those two assumptions have actually been debated and shown to be false in some instances. And they were really the basis of a couple of Nobel Prize in economics. And the fact that those assumptions do not always hold true is the basis for what I do as a trader and what StockScores.com does as a tool. You see, I recognize that information matters, but it's important to understand that not everyone gets the same information at the same time. There are those who are close to companies who will get information sooner than people who are out in the public. So if you imagine the spread of information being much like a stone being thrown into a pool of water, when that stone hits the water, there's a ripple effect, right? And if you're close to the stone, you get hit by the ripple sooner. And as a result, if we think about this metaphorically as information, what we're really saying is people closer to the source of the information are going to get that information sooner, and therefore they have an advantage in the market. And this is one of the breakdowns of market efficiency. Another breakdown of market efficiency is just the simple fact that people are emotional. And there's a whole world of study in financial theory called behavioral finance that looks at how human beings act irrationally. And those are things that create opportunities. Now, as I said earlier, information matters. As an investor, your job is to look at information and try and figure out what it's all worth. Well, some people are getting better information than others, and so therefore they have an advantage in the market. As I said, investors can often be emotional, but it's also important to recognize that the sources that you use for information can be very biased. Imagine an investor that already owns a stock and they're telling you about that company. Well, they've got a vested interest in telling you the very best things about what that company does, about its prospects, that sort of thing. They have a bias in how they provide you with information. There are all kinds of biases that exist in the world when it comes to information flowing from the source to the investor. And you have to recognize that. There are people that get paid, they're called promoters, who get paid to paint a very nice picture about a company. There are companies that advertise on TV about their stock and about what a great company they have because they want to get their stock price as high as possible. Even the media has a bias because at the end of the day, the media is guided by the need to sell advertising, and the more entertaining they make the TV programming or the radio or whatever it is, the more people will tune in, and that is how they make their money, and therefore they have a desire to taint the information with some entertainment value to try to get you to tune in. And so that can introduce a bias as well. So my point in all this is when you are making investment decisions based on information, you got to be real careful not to get swayed by the biases that exist. Now this brings me to the two types of analysis that we do as stock investors or stock traders. The first is fundamental analysis, and the second is technical. Fundamental analysis considers the information about a company's business activities and the factors out there in the world like the economy, the politics, the conflict in the world. We call those the macro factors. And we take in all this information that's specific to the company and that's specific to the macro factors, and we determine a share value from that. And that's a difficult calculation to make. You got to study a lot of information. You have to have a lot of expertise in an industry. It's not something that any old person can do unless you have some expertise about energy stocks. How can you really evaluate the value of an energy company? Now, the other side of the analysis equation is technical analysis. And what technical analysts do is they consider how the stock is trading, what the price action is, what the volume action is, and what that reveals about what people perceive about the company's fundamentals. When someone says, well, I think this biotech stock is going to announce some big news on a new drug that they're developing, that's the fundamental side. The technical side says, ooh, look, this stock all of a sudden started jumping up in price and is trading heavy volume. It must be because someone has some new information that makes that company worth more. Now, I tend to favor the technical side because I think you can analyze any stock, anytime. I don't have to have a level of expertise about companies. and it's a much cheaper and more time-effective way to analyze stocks. All I do is I look at trading activity and I say, what is this trading activity saying about what people know about the company's fundamentals? And so that's the approach that I take. All right, well, that has been a quick overview of the introduction to the stock market. We've talked about where price comes from, how the stock market works, and the types of analysis that exist. Remember, there's lots of biases in the information that you get. At the end of the day, trust what the market's message is. That's what I do, and that's really the basis of the stock scores